All right, welcome everybody to the UTC Small Fund ISM. This is the first one for this semester, and hopefully it'll be the last one for a while that will be via Zoom. We hope to be on campus for the next ISM, and we may even have Gary W. Rollins as a guest. So hopefully that'll be a great one. We're also, as I'll mention in a minute, leaning closer and closer to $1 million. So maybe at some point here in the in the next year or maybe even sooner, we can celebrate that milestone as well. For those of you that are new, the Small Fund, SMILE is an acronym for Student Managed Investment Learning Experience, and we believe we're the premier program on campus. Next, please. Before we get going, I'd like to thank everybody that has come and that participates in the SMILE Fund. I'd like to thank our foundation board members. Without the foundation, UC Foundation is our actual client. So without them, SMILE Fund would not be possible. I'd like to also thank all of our professional advisory board members, and I plan to provide some more information about our professional advisory board at the next ISM. We have added 4 new people to the board, and I plan to hold a meeting with them sometime soon. We have Jeff Turner from Continuum Planning Partners. We're trying to add some more board members that have a little bit more CFP type experience too, because there's some mentor opportunities there as more students are interested in in financial planning as well. Tiga Eda is in the investments group at Unum. Ben Cheatham is a former SMILE Fund student. He has a CPA now, and he is an origination analyst with JP Morgan in Chicago. And then Josh Carlisle got his master's from Vanderbilt, but he's a former UTC SMILE Fund student as well. And he's a senior analyst with Ernst & Young in New York. So as we add some new members to the advisory board, and we will probably have more SMILE Fund students come onto the advisory board now that we're getting 5-6 years out. So that'll be interesting too. And I will once again give you some more information there. Thank you to the SMILE Fund Junior Advisory Board members, and thank you to the faculty, staff, the SMILE Fund students, the GRIN Fund students. I haven't mentioned the GRIN Fund before. It's our Graduate Research Investment Fund. It's a simulated fund. One day maybe it will have real money, but basically the graduate students that are interested in investments get together for an hour each week to discuss how to manage that simulated fund. Other UTC students and any guests and longtime UTC supporters. Next, please. All right, as you can see, we are closing in close to $1 million. We also have we're running at full capacity. It's pretty impressive how well we've not just survived, but thrived during the move to online. We managed to actually increase our membership. Everything has been running pretty smoothly. And it's been a testament to how much the students care about this program. We also have a newly refurbished state-of-the-art Bloomberg lab. And so the students will be using that more and more as our remote terminal access to those terminals is going to be discontinued soon. So hopefully it'd be nice to have everybody back on campus. That is certainly where we're trending. And if you look here, I just want to mention that we've done very good performance-wise. Now this last year, they're going to talk and they're going to be upfront a little bit about some bumps in the road that we've had with a little bit of underperformance this year. But if you notice, some of that it is going to be due to not changing the investments that we had last semester when we clearly outperformed. I mean, last year when we clearly outperformed. So all in all, they've done really good. But this year they have some underperformance, and they plan to discuss how they want to address that. Next.
Hey, Hunter.
Yes.
Sorry. 2 things. I think if we go back to the previous slide, Luke.
Sure.
The second bullet point's a little bit misleading. It kind of leaves the impression that you've had that level of growth.
Oh, okay. Absolutely. Okay. So, so we received $250,000 initially in 2015, and we received another $250,000 in 2018 to start the strategic fund. So we have $500,000 that have been put into the fund by the UC Foundation, and then the rest of that is growth.
Yeah, so I think that for the next one, especially with the names that you said are likely to attend, I think we need to make sure that that's very clear. Second, on the first slide of a presentation like this, when you include a return table, given the fact that we're in the middle of September, I think it has to have year-to-date numbers. You know, you stop at the year-end 2020. And
Oh yeah,
I think-
this is me just prepping it. The student officers are clearly going to talk about year-to-date numbers.
right.
So
But
I just stole this from our newsletter that we were going to send out. So
right, but I flipped through the chart deck and I don't see that table updated. Meaning, I mean, I think that's a good table. It's a format that you've been using for about 4 or 5 years. So I think for the sake of consistency, but I don't see that table recreated. And so I guess
so you'd like to see this specific table with the 2021 numbers in it as well in the future?
Yeah, because I think what we want to see is the annualized since inception.
Okay. Yeah, I think
That's
yeah.
very important.
Okay, great. We will do that. Make a note of that. We will make sure that that happens for the next ISM, guys. Also, you will see that Luke presents some of the since inception numbers. He'll show it in a slightly different way, but absolutely, I think that we need to have that in the chart. Okay.
Yeah.
Good point. All right. So just want to point out that for anybody that's brand new, especially some of the new faculty and maybe some of the new board members, that we usually try to do these at least 2 times a semester. We were doing 3, but I think we're kind of settling into a quarterly basis for these investment strategy meetings. We also have had some continued success outside of the small fund and some of the competitions that our small fund students enter. We have won the CFA Greater Tennessee Research Challenge 5 years in a row, and we're about to start that up again this semester. And we have also won a new Global Equity Research Report College Challenge the last 2 years in a row. So we would like to find different opportunities to showcase what our students know how to do. And we hopefully will get to take students back to New York at some point, whether it's the game forum or for a CFA event or something of that nature. So we like to do as much as we can for the students and to showcase their success stories. Next. Speaking of success stories, our junior advisory board has some CFA exam accomplishments. So if you haven't heard or weren't at one of the ISMs last semester, we had 4 students pass a different level earlier this year. Colton Hobbs passed the final level. He's now a senior financial analyst at First Horizon. Ryan Walker passed level 2. He's an investment strategist over at Acumen. Next. And then we had 2 of our students pass level 1. Bench Russell, who was one of the students that won the that small cap equity research report contest last year. He passed level 1, and he is now an investment banking analyst at Four Bridges Capital here in town. And then Nick Wilson, who was on a CFA team quite a bit ago, I think it was our second CFA team. He's passed level 1, and he works as an investment analyst at Commonwealth Asset Management out in Los Angeles. Next.
Hunter, I'd like to add that we have 2 other charter holders as well of our graduates, Connor Hale and Thomas Dance. I don't know if Connor was part of the Smile Fund, but just to indicate, we've had very good success rate with charter.
Yes, I should have included both of them. Thomas Dance was a student, I believe, the year we started the Small Fund. So I'll probably try to get him on the board at some point, and he didn't get the opportunity. And then Connor Hale was in the Small Fund. So thank you, Bento. And then also
he has just taken a position with Smile Direct Club, and I was telling him we had a sell recommendation on them not so long ago. But anyhow,
we were right.
Yeah, they're down around $4 or $5 now.
Yeah, we were right.
Yeah, so that recommendation, they may be a buy now. We might have to reassess that, but there's probably still some issues. But yeah, so we have a lot of good success stories here. If anybody knows of anybody that has passed any level of the CFA or even the CPA or any other certifications that we would love to showcase our success for our students. And I think it's going to be a testament to UTC and to our the Finance and Economics Department and the Smile Fund when we have a strong number of CFA charter holders within this community. So with that being said, I'd like to go ahead and move on to the bulk of our presentation. I forgot. We have 2 more ones that just passed the level 2 here recently. Grant Allen is portfolio manager and investment strategist at Acumen. And then Chandler Thurman also passed level 2, and he's on the board, on the junior advisory board, and he's a research associate at the patent group. So lots of good news here. And so I think that this is basically the bulk of what I wanted to highlight, and we'll let the students run the ISM. So next slide, please. So I'll hand it off, but I just like to remind you guys that we like to set a high standard. Do not feel bad about asking these students tough questions. We want you to pull no punches. And as far as a theme, we're going to start maybe, mentioning a strong theme for each ISM. And we were discussing this last night, so we didn't really come up with a theme to put in the slides, but the best one we came up with, that Luke, our president, came up with, was Delta versus Delta. Meaning that, we're going to talk about the Delta variant, and we're also going to talk about their upping their position in Delta stock, and how, you basically, one's going to go down and we think the other one's going to go up. So with that being said, I'd like to turn it over to our president, Luke Johnson.
All right. Thank you, Dr. H, for that. Good morning, everyone. Welcome to this Smile Fund ISM. As usual, it's great to see you all. Even if it is over Zoom, we're very grateful for everyone in attendance and hope that you all enjoy our presentations. So I'll go ahead and walk everyone through our agenda for today's meeting, beginning with the officers. First, you will hear a performance update from me, followed by a macro update from Jenny, who's our Vice President of Macro Analysis. Next, you're going to hear an update from our VP of Risk Management, Logan, who will also cover weightings and allocation as well as contribution. Today, you'll also hear a stock presentation from Justin Martin, who's a chief analyst in the IT sector on an industry-leading PC gaming company. And then to wrap everything up, we will end with the second stock presentation from lead analyst in the communication services sector, Dennis Varghese. All right, so if you do not already know me, my name is Luke Johnson. This is my first semester as the president of the Smile Fund, and I'll go ahead and kick things off with a performance update. So to give a quick update, as Dr. H has already talked about, combined, we're currently standing at $966,675 total market value. I will note that's as of yesterday. And with roughly $600,000 of that in the traditional fund and around $370,000 of that in the strategic fund. So our traditional fund was created July 1st of 2015. And since then, we've returned about 134%, coming in just under the S&P 500, which we use as our benchmark for this fund. So to go ahead and get into our year-to-date performance, our traditional fund has returned 14.11% year-to-date, while the S&P has returned 20.16%, and this is as of Monday. We attribute this underperformance primarily due to our poor first quarter, where we failed to transition into higher weightings in reflation and reopening style stocks, as we were overweight in technology and communication services, which helped us to outperform the S&P by 12% in 2020. More recently, though, we have also struggled to outperform the S&P due to trades which would benefit from decreasing COVID cases and demand for travel. Jenny will discuss our outlook on these topics more in depth during her macro presentation. So this graph here represents our year-to-date performance difference compared to the S&P 500. As is evident in the steep decline through the first half of the year, we underperformed quite drastically, which, as I just discussed, is primarily due to our overweighting in tech and communication services, coupled with underweights in reopening and reflation style stocks. But since that first half of the year, we have regained some ground on the S&P due to a rebound in these tech holdings as we forecasted. But we've also been held back recently by trades that would benefit from declining COVID cases and increasing travel, as the Delta variant has caused quite a large wave of new COVID cases. We foresee these holdings as decreasing our underperformance through the rest of this year as we forecast declining COVID cases, which again, Jenny is going to talk about more in depth during her macro update. Okay, so this table represents our bottom 5 contributors to return through June 1st. And the reason I chose this timeline is that is capturing that beginning half of the year where we saw that decline in our performance relative to the S&P. I wanted to show this table to speak a bit more on that first half of the year. At the bottom of that, we saw 8% underperformance relative to the S&P 500, and 4 out of our 5 bottom contributors to return were made up of 2 communication services stocks and 2 technology stocks. We were overweighted in these sectors through this time period, which is what we attribute this underperformance to. So transitioning over to this past quarter to date, 2 of our top 5 contributors to return belong to our bottom 5 contributors through the first half of the year, and that's Apple and DraftKings. And this reflects truth to our belief that these stocks would rebound. But moving over to our bottom 5 contributors to return quarter to date, you'll see our greatest is still Roku. So Roku actually did rebound from their lows seen during the first half of the year as we forecasted, although since then it's dropped back down to that level as it has been quite volatile. We're keeping a close watch on Roku, but yet again, we do continue to believe in the company and do see it as a long-term winner in the communication services sector. So our second bottom contributor to return was Enphase Energy, who we purchased when their stock price fell due to supply chain worries, at which point the stock actually returned 25% back to us once we were invested. At this point, we did cut our weighting due to that volatility. So although they are one of our bottom 5 contributors to our performance, if it were not for this trim weighting, we would have seen much greater losses of gains that we experienced from the stock. We also view Take-Two and PayPal as long-term winners within their respective sectors, despite their recent declines. Okay, so here are our top and bottom 5 contributors to return year to date for the traditional fund. Our top 5 contributors are made up of discretionary stock Chipotle, who we purchased earlier this year, anticipating consumers returning to restaurants, which would benefit Chipotle, as well as Chipotle's delivery options, which allowed them to slightly increase prices to offset slightly higher costs. Also, some tech and communication services companies such as PayPal and Microsoft and Alphabet are our top contributors, reflecting our belief in these quality tech names. JP Morgan, who benefited earlier in the year from increasing yields, still holds a position on our top contributors list. A few of our bottom contributors year to date, again, have been Take-Two and Roku, who we maintain long-term belief in. And to get to Delta Airlines, it is our largest bottom contributor to return year to date, as we did increase our weighting in our most recent trade request. But although Delta has contributed to declines in our portfolio, as you're going to see from Jenny's outlook, we have taken the stance that COVID cases will decrease in the near future and that travel worries will be temporary. So to cover our most recent trade, we shifted our holdings in healthcare from Zoetis and Viva to Jazz Pharmaceuticals and Cigna Healthcare. We also cut our weighting in tech by selling Autodesk and Cisco and trimming Enphase. Autodesk and Cisco had performed well for us, and we viewed them as overvalued at the time. We wanted to maintain some weight in Enphase, as we do believe in their business model, but we wanted to mitigate that risk to their volatility, as well as take some profits from their great performance and move that weighting into more traditional energy companies. With this weighting from tech, we funded our purchase of Chevron, as well as our increase in Delta Airlines and Valero. We added weighting in energy through these companies during heightened worries about energy demand declines due to increasing COVID cases. And we took this as an opportunity to buy, as we view these worries as temporary, which again, Jenny will talk about more in depth during her outlook. We also increased weighting in Delta Airlines for the same beliefs that COVID cases will decline and travel worries should mitigate. Finally, we shifted our weighting from UPS to FedEx and industrials, as we do believe more in FedEx's growth over UPS's due to their more diverse business model. So I'd also like to briefly touch on our strategic funds year-to-date performance. The strategic fund has returned 14.02% year-to-date when compared to their blended benchmark, which returned 16.87%. Our small and mid-cap sector ETFs have performed well year-to-date, along with some tech holdings such as Proofpoint and Jabil. Our major detractor from performance has been from individual stocks in industrials and communication services, though. So in our most recent trade in the strategic fund, we trimmed our weighting in the iShares Core MSCI EAFE ETF to fund our purchase of Intersys, a manufacturer and distributor of industrial batteries. Intersys has been a detractor on the strategic fund's performance recently, as they narrowly missed Q3 earnings expectations. But Intersys still had strong earnings in Q3, and we forecast strong future earnings growth. So now I'll take any questions, then go ahead and get into Jenny's presentation.
All right, well, hello everyone. My name is Jenny Poo and I'm the VP of Market Analysis. Today I'll be going over an overall view of the economy, and later on Logan will go more in depth in how we are incorporating this information into our investment strategy. Okay, so for my presentation, I'll start off with the COVID-19 update, then I'll transition into unemployment, inflation, spending, and wrap it up with an overall summary. Starting off with the COVID-19 update, we can see with the rollout of Pfizer, Moderna, and Johnson & Johnson in January and February of 2021, there is a drastic decrease in COVID cases throughout the months. There's like a little animation there too. As the Delta variant became more prominent in July, we can see an increase in these cases. However, it has started to settle down in the beginning of September. The CDC recently announced that boosters should be given out 8 months after the second dose of the vaccines to create longer lasting protective immunity. With the booster shot and FDA approval of Pfizer, we believe that the number of COVID cases will likely decrease as more people are more comfortable with receiving the shots. As we can see here, hospitalization rate for the Delta wave is significantly lower than the beginning of the pandemic. In fact, for the week ending September 4th, we can see a decrease in hospitalization. If we look at the age distribution, we can see that it remains constant, with people 65 and older being the ones that are mostly hospitalized, with the lowest rates including those up to 17 years old. For the week ending August 28th, there is a 9.5% difference between the ages 50 to 64 and 65 plus. For the week ending September 4th, their difference decreases to 5.8% between the two age ranges. This signifies that the distribution amongst the age range is decreasing, with the possibility of reaching what we saw in June and July of this year. Moving on to vaccination rate, we can see that of the whole US population, at least 63.1% have one dose and 53.8% are fully vaccinated. However, if we take into consideration of those aged 12 and above who are allowed to receive the vaccine, the percentage goes up to 73.8% for one dose and 63% for those who are fully vaccinated. The graph here shows a decrease in the vaccination rate. However, there's still a substantial amount of the population that is fully vaccinated. In addition to that, with Biden's mandate to require vaccinations for employers with 100 or more employees or weekly testing, there's a possibility to see an increase in the vaccination percentage. Okay, so what I have here may seem confusing at first glance, but it's fairly simple. Represented here is the effective reproductive number, RT, for each US state. The study was done by Yale, Harvard, and Stanford, where they gathered data on each state. They take into account the average number of people with the virus and how transmissible it can be to others. So to start it off, the meaning with the graph.
And I'll jump in here real quick just to point out that every one of those dots represents a state. So if you've never seen a graph like this before, just kind of note that every single one of those dots represents a different state. Please go ahead, Jenny.
Yeah, I was going to mention that, but and when the reproductive number is above 1, we expect cases to increase in the future, and when the reproductive number is below 1, we expect cases to decrease in the future. So to better explain that, as he said, if we look at the graph, each dot represents a state, and the goal here is to get all the dots below 1, which would signify that we expect cases to decrease in the future. And starting off with the first quadrant here outlined in yellow, we can see that there are 17 states that are above 1 but are downward trending. And all the numbers that are here are initial values from 1 week ago, so I decided to compare it to the current values from Tuesday. We can see that it has significantly decreased to 3 states that are above 1 and downward trending. We'll see later on that many of those states have actually moved into the green quadrant. When we move on to the second quadrant outlined in red, we can see that there are 7 states that are above 1 and upward trending. If we look into what it is currently, it has decreased to only 2 states that are above 1 and upward trending. Lastly, in the third quadrant outlined in green, we can see that there are 26 states that are below 1 and downward trending. And if we can compare it to where it is currently, it has already increased to 45 states that are below 1 and downward trending. With a significant decrease in just 1 week, we are hopeful that upward trending states will eventually transition into downward trending in the near future. Therefore, with this outlook, we are bullish on the overall stock market and in certain sectors that Logan will talk about later in his presentation. For the unemployment rate, the main idea here is a significant decrease since the start of the pandemic. Here I have a graph representing the unemployment rate versus the U6 underemployment rate. At the peak, the unemployment rate was roughly at 14.8%, has since then decreased to 5.20%. With the ending of the pandemic-related unemployment benefits, this has the possibility to lead into a continuation and a decline of unemployment rate. In addition to that, the U6 unemployment rate includes the total number of unemployed, underemployed, and discouraged workers. At the end of August 2019, there was a 3.5% difference between the two rates at the end of August 2021. The difference between the two rates is 3.6% because the differences between the two rates is so small. This shows that even with the pandemic, there has not been a major increase in the number of unemployed, underemployed, and discouraged workers.
Deborah, do you have a question?
I do. I want to make sure that while the data looks good for the COVID numbers, that we also acknowledge that there was a holiday in that last week. So those indicators are lagging, and we know that they are underreporting. So before we get too excited, I mean, it's favorable, but be wary of the fact that the holiday week and the lag time causes those indicators to look better than they suspect that they are.
Okay, yeah, it's a fair point. We'll definitely need to take a look at that and see if we see that these numbers keep trending this way after a regular holiday. I mean, after a regular weekend following a holiday weekend. Good point.
There's actually, I mean, there were a couple of articles on the Wall Street Journal stating that a lot of people have dropped off the workforce, and that is probably skewing the unemployment numbers. People have changed the way they work, and they probably have dropped off the workforce. So this is just unemployment claims that we're talking about. So that is something that we also need to be mindful of.
Yeah, and we discussed last night too, to be that we're looking into the effects of what happened when they've cut some of the unemployment benefits. So yeah, we acknowledge there are a couple other factors to be looking at.
All right, well, thank you. And then moving on to the job openings, only 235,000 jobs were added in August compared to the 935,000 jobs in July. However, we don't see that the addition of fewer jobs in August to be a big issue. As Jerome Powell has said, with vaccination rising, schools reopening, enhanced unemployment benefits ending, the factors that hold back job seekers are fading. And this graph depicts the US total number unemployed versus total number of job openings. At the start of the pandemic, we can clearly see the total unemployed far surpassed the number of openings. Around May, we saw the two intersect, and now job openings exceed the total unemployed by approximately 2,200, which then again proves the growth in the economy and adds to our bullish outlook.
Hey, Jenny,
That's 2.2 million.
yeah, 2.2 million.
Oh yeah, my bad.
Yeah, might want to just put that in and scale it out. Yeah.
All right, and then the inflation measured by the Consumer Price Index for the end of August is currently at 5.25%. At the end of July, the CPI stood at 5.37%. Therefore, with the slight decrease in inflation, it relates to the Fed's view on how inflation is projected to be transitory. Looking at the 5-year TIPS break-even index, we can see that inflation is predicted to be at 2.5% 5 years from now. Although this is still above the 2% target rate, we see a drastic decrease from the current rate and assume that this is only temporary due to the supply chain disruptions and consumer demand outpacing supply. And with this quote from Jerome Powell, he expresses how long-term inflation expectations have been much less than the actual inflation rate and is likely to prove transitory. This appears to be accurate because of the slight trim in inflation in just the past month.
One more thing, I mean, there was a survey of future expected inflation, and for the next 3 years, expected inflation, according to that survey, is 4+%. I don't remember the exact number, but there was an article in Wall Street Journal a couple of days back about that. So, I mean, although the Fed is not acknowledging inflation and it's continuously saying that it's transitory in nature, I think the expectations pertaining to inflation are, I mean, it's gonna stay. It's not something which is like completely transitory.
Yeah, that's something that we'll definitely keep an eye on as well as we.
Nilesh, were you seeing specific estimates, or I mean, are we looking more in the 4% range or 6% range, or
It was 4%.
I thought I saw 4%. The last time I read was what was expected.
Yeah, the survey said 4%.
Okay.
4, I don't remember. It was something between 4 and 4.5, something in that range. I don't remember the exact number, but yes.
I think that goes along with the data that we have on the slide right here as well. So
Right.
okay.
Yeah, but the transitory thing that the Fed is continuously harping, that is something, and this was for the next 3 years. So it's not something that is like super transitory or very short term kind of thing.
Okay.
Next slide. All right, so this graph shows the core personal consumer expenditure, PCE, versus the Dallas Fed trend mean, PCE. This trend mean excludes the most extreme upside and downside price that could overstate inflation. This is calculated by taking the difference of today's current rate and the base rate from 6 months ago for the 6-month mean and 12 months ago for the 12 months mean, creating an annualized rate. Although it is still slightly over the 2% target in each category, it is significantly lower than the core PCE. We can see that while taking out the ultimate outliers, we can see the core inflation in the economy. Therefore, with these low inflation numbers, we can see that this benefits the economy. The US Treasury yield rate reflects how investors see the economy. The distance between the 30, 10, and 5-year yields have remained constant. With the fairly low rates, we can see that the market is not as worried about inflation. And with the decrease in yields, we project that there will not be a tantrum, which I will talk about in the next slide. All right, and then with supply and demand imbalances improving and the reduction of the unemployment rate, the Federal Reserve notes that by the end of the year, they will start to taper. This involves reducing asset purchases or quantitative easing and increasing target federal funds after that. This will slowly remove the monetary stimulus it was providing on the economy. The tapering in 2013 occurred earlier than expected, which caused an increase in the Treasury yield rates. However, when the Fed has continued to signal that tapering will occur, we don't believe that there will be a tantrum. In fact, if we look at the end of 2020, we can see an increase in these yields, which could be due to the fact that this fear of a taper tantrum has already been baked in. This implies that tapering may not be as large of an issue this time around as the market has had time to prepare. And then since then, the yields have actually declined, even with the Fed's remark of a taper happening soon.
Hey, Jenny.
Yes.
First of all, really good job on all of these. So these charts look really nice. I've been really impressed by the actual slides, but I was just curious if you could walk us through a scenario in which you think tapering would not happen. So do you see a possible outcome where the Fed does not taper or cannot taper, and what might that look like?
Well, I mean, in order to maintain the money supply that's going on in the economy, I feel like they would have to taper in order just to balance it out and improve the economic growth. That makes sense.
No, I mean, I'm not saying you're wrong. I'm just playing devil's advocate here.
I don't know if that actually answered your question, but okay.
Yeah, I just have a thought on this. I mean, when you're talking about tapering, although interest rates do react and respond to the taper, but I thought it might be helpful to show a chart of the Fed's balance sheet, which is in excess of $8 trillion now. And also what they're saying about their asset purchases. I think it's $130 billion a month or something like that. And if there is a taper, how much will that shrink by?
Maybe something that you could add is the global thing. I mean, after the Fed announced a little bit about tapering, I think the ECB followed suit. Previously, the ECB had indicated that they would continue the easing and they would keep supplying money to the markets. But however, after the Fed announced the tapering, I think the ECB also projected that they will cut down their pumping money into the market by approximately 10 billion euros a month. So that is something that is, I mean, it's kind of a global thing that's going to happen across the board. So yeah.
Yeah, that's a great idea, Vinod, and thank you, Nilesh. We can get that information for the next ISM to look at the Fed's balance sheets. And back to your question, Stephen, I think that would be almost the opposite prediction of what they have going here. This is very bullish take. So something very bearish would have to happen, right? So I guess you're looking more for the COVID cases to get worse, or the pullback in the unemployment benefits to have some kind of more disastrous, I guess, impact on the economy.
The mu variant becoming significant. After Delta, it's the mu, right?
Right. Yeah. So especially if it can get through, if the vaccines don't prove to be very useful against it.
All right, so for my next slide, for the open table seated diners graph, we can see the 7-day moving average to be roughly 10% below pre-pandemic levels. As cases begin to decline, we expect these to meet and exceed pre-pandemic levels as people are more comfortable to go out to restaurants. And then for the second graph here, I have the TSA checkpoint numbers. We can see that there's a decline in air travel starting July and August of 2021. Despite the decrease in travel, we expect these to return to normal levels as seen from late this summer. Again, we expect this to be a temporary decrease as consumers begin to adapt to the virus like the flu. And for consumer confidence, it's currently at 113.8 and recently started to decline, which is associated with the rise in COVID cases. In fact, from this graph, we can see that at the end of the summer, consumer confidence reached roughly 128, which is close to the pre-pandemic levels. We can see that the Delta variant has caused many of the trends to go down, such as consumer confidence and retail sales, and has caused the personal savings rate to increase. However, once cases decline, we are hopeful that these will eventually bounce back, in which we will need to take into account as we position our strategy.
Hey, Jenny, I'd like to make one suggestion to you. When looking at the consumer confidence numbers, there's usually some pretty good information in that report. They quiz people on two horizons. One is their current situation, and one is what they expect 6 months from now. And it might help to sort of break out that sentiment, given how volatile things are, right now. So they may have the most recent reading was a sentiment had deteriorated a little bit compared to previous readings. So it might help to look at those two horizons when you examine consumer confidence.
Yeah, I'll definitely look into that. Next slide. All right, so overall, as we can see, Delta has caused a clear spike in COVID cases. However, with Biden's vaccination mandate and the effective reproductive number outlook, there's a possibility of COVID cases to continue to decrease. We also see unemployment and inflation as not being critical issues. Currently, with the job openings exceeding the number unemployed, although inflation is high, we see this as temporary once consumer demand meets supply. With a decrease in overall consumer spending, again, we see this as only being temporary as more people will spend based on pent-up demand in the future. And that's all that I had for today. So thank you. And I'm open to any questions now. And I'll pass it on to Logan, who will go over more in depth of how these economic factors can impact our fund.
What guidance would you offer the asset management team based on your research?
I mean, just keeping an eye on the unemployment and how that could affect everything with the ending of the benefits.
Yeah, I guess my question is, what are the implications for your holdings? Now, I know Luke touched on that early on, but your macro analysis should kind of dovetail with the position of the fund in terms of how they're positioning the assets or changing weights or positions within the fund.
Yeah, and Logan will actually touch up on that
Okay.
in his presentation.
All right, thank you. Great job.
You could say simply like go for cyclicals or something like that, because you're expecting the economy to go up again.
Right, yeah, so I think what we tried to do so that Jenny didn't steal the whole show, because she has some amazing slides, was that after her, Logan's going to talk about how they're going to use this macro information to impact the strategy for this model fund. So, which we can maybe then come back if those questions. If you got any specific macroeconomic questions for Jenny, you can go ahead and ask them now, or you can even bring them up again later.
I have a question.
Sure.
With the impending infrastructure bill, do you think that have anything to do with all what's going on here? All what you expect?
So Jenny, do you think the Biden's infrastructure bill is going to impact your outlook that we've discussed here today, or the small fund in any particular way?
Yeah, I guess just depending on how that plays out and everything, but I'll look into it.
Luke, do you have any more thoughts on the infrastructure bill?
So right now, I think that the market kind of, was anticipating the infrastructure bill really having some effect in the market. I think right now that is a little bit already baked in, as we like to say. But I think if anything can happen, it would end up being bullish, for more of a bullish tailwind.
I seriously don't think so. I mean, if they end up pumping $3.5 trillion into the economy, the transitory inflation is gonna blow up big time. And then the Fed would have to take more measures. I mean, the fiscal spending needs to be balanced. by monetary policy. You cannot just keep pumping free money into the economy at whatever time you like. So that would change a lot of things.
Okay, that's a wonderful point.
I don't think that's going to be very bullish. I mean, there's going to be bullish for certain sectors, not for the overall economy.
Right.
Well, it might be bullish in the short term. I do agree with you, Nilesh, that it could have some long-term consequences. But certainly you're right, Luke. You'd have to look at it, and Nilesh, you'd have to look at it by sector basis for sure.
Right. I definitely agree with that. We would need to focus maybe even more on the company side focus, where we're focusing on specific companies that may benefit, but that's a great point.
That's probably coming up at the end of this month, like beginning of October, I think. That's when they're gonna, I mean, there's a debt ceiling proposal, and they're probably gonna tie up the spending bill with it or something like that.
Jenny,
So-
in the next ISM, can we report on Biden's infrastructure bill and also on the chances of the corporate tax rate increasing? Because I do think that those could be some
Right.
potential tailwinds or headwinds for certain sectors, and we want to make sure we discuss that.
Yeah, definitely.
Yeah, that's a very good point, Dr. H. I mean, if you spend, you gotta tax it from
Correct.
somewhere. Okay.
Yep. All right, and I saw where they're adjusted that potentially from 28% corporate tax rate to 26.5%. That leads me to believe if some negotiation is happening, that it might actually get passed sometime in the next year, which if it's going to get passed, you think it would want to get passed before midterm. So that could provide some headwinds that we want to make sure that we're considering. So. All right, Logan, why don't you give us our overall strategy and as far as how it relates to this macro strategy, and I'm sure you're going to get lots of good questions.
All right, I'm ready for it. I'm Logan Painter. I am the VP of Risk Management, and I'm going to give you a little update on it. We're going to start with our performance metrics in the traditional fund. Here I'm talking about trainer ratio. In 2020, the Smile Fund outperformed the S&P 500 enough to where the trainer ratio showed that our portfolio was a more suitable investment. But as of now, our trainer ratio is still underperforming the S&P 500. Through this ratio, we will look at what has been driving the performance and how we have changed our weightings and selections to capitalize on the economic conditions that Jenny has just talked about.
Logan, may I ask a question?
Yes.
You used the word suitable. I'm not sure I understand why trainer ratio defines a suitable strategy. What does suitable mean?
Well, I would say I used it in a way that was a more suitable investment. I say a better investment.
Well, let's start from square one here. So trainer ratio is what? What's the calculation of trainer ratio?
Trainer ratio is our return minus the the 10-year treasury rate divided by our beta.
Okay, so it's a risk adjusted measure of
Yes.
return, right? So basically, again, this beta calculation here, was that at year end or was that the average beta over the year?
That
2020.
was average beta over the year, as well as the average 10-year rate for the year.
All right, so in other words, you guys had a great 2020. Your risk adjusted returns and your absolute returns did very well. And so this year your beta creeped up and you didn't get paid for it, right?
Yes.
That's basically what you're saying? Okay, so you took slightly more risk and that risk didn't pay off for you. Your absolute returns lagged the S&P year to date, and that's reflected in the trainer ratio, right?
Yes, but
So
I don't think that has everything to do with our beta, seeing as though at the start of the year, we even had, for the second ISM, we had a much lower beta than what we see here, but we actually had a worse trainer ratio.
Okay, but again, I think what I'm getting at is the comment about suitable kind of stuck with me here a little bit. And so a way to characterize this maybe just in terms of making sure that everybody follows in the audience is that you took less risk last year and your returns were superior. So that's a really good payoff profile. This year, you did not, you increased the risk profile and you did not get paid for it, right? So there's an aspect of this that perhaps reflects maybe bad timing or should be confirmed, I think, in your contribution attribution analysis that shows maybe some of the stock selection didn't pay off this year, right? So I guess at that, just going to maybe suggest to you, you're putting a qualitative factor in there where you use the word suitable. And maybe what you want to do is just leave it in the context of risk and return and whether or not the risk you take, the risk that the Smile Fund took this year paid off in terms of the return, because it didn't appear that it did. That's kind of the way I would suggest phrasing it.
Yeah, and
All
to build on that, if you might have heard the word suitable in my class when Logan, when we were talking about this, in that a trainer ratio is more suitable for a diversified portfolio than a Sharpe ratio. And so that may be where you picked up that word, but I think you used it a little bit out of context here. As far as the beta goes, and don't let me put words in your mouth, tell me if this is true, but I think you guys still want to maintain a beta that is slightly higher than the S&P 500 because you maintain a slightly bullish stance, and you might have, gone bullish a little too soon, but you think long-term that you guys are still somewhat bullish and you still prefer a slightly higher beta. Is that true?
Yes, I even see this beta as a lower end beta for how we have changed our allocations.
Okay.
All right, next slide. We're gonna look at my attribution summary. So I'm gonna start off by saying our allocation has gotten a lot better as our weighting changes have worked more as we planned, but we're still changing our weightings around even more. We have made a lot of progress since our last ISM, but we are still seeing the negative effects of our decisions from the start of this year. This is very clear when you look at our total return and selection percent in communication services, consumer staples, and information technology. This table really puts an emphasis on our selection effects being the root of our problems for these sectors. But the past is the past, and we can only learn from this, which I believe we have done, and we continue to look for new changes to our portfolio as we press on in our pursuit to hopefully beat the S&P 500. In order to do this, we have been working on our sector allocations and have already made many changes during the summer, which you will see in one of my later slides.
Logan, can you actually go back? I had a
Yes.
question on that slide. So I know you said the past is the past, but I'd actually like to talk about the past here. So
Let's hear it.
we're showing year-to-date attribution right here, and it looks like security selection has been not great across the board. If we look at other time periods, so if we look like a 1 year, maybe we go back another year, 3 year, 5, whatever, is that the same story? Have we consistently been bad at stock picking? And if so, why, and what are you doing moving forward to try to remedy that?
So that has been the case pretty much historically. When you look at the Smile Fund, the selection percent has never been as good as allocation. I feel like
Well, actually, before you go down that story, I don't know if you know the history. It's actually been the
2 years
opposite.
back.
So
least 2 years
we've
back.
actually been historically much better at stock selection than at asset allocation.
Yeah.
But here recently, this is a stock selection issue. So you might have not have known that history, but what are we going to do to remedy this?
We are moving into higher weightings into some of the positions in select companies that we think are going to perform extremely well. That has been an entire team discussion for the longest time now, and I think we have finally set into a sort of belief that we are going to go off of for the rest of this year and continuing on from then.
And Stephen, they're addressing 2 of these sectors with stock presentations today. So,
And then it looks like this table is basically saying you had a blow up. So is Roku in communication services?
Yes, Roku is in communication services along with Take Two.
All right, so those two stocks are what's killed your year.
Yes, other than those two in that sector, it has been very minimal. Does that answer your question?
Yeah.
All right. All right, here's some changes that we made and future changes to come. We plan to continue reevaluating our holdings once they reach our target prices that we have set for them. If we end up selling out of a stock due to it reaching our designated return, like we did with these three companies, we will either reinvest those stocks weighting back into the same sector or industry like we did here. Or if we go into my next slide, sometimes we will take the weight out of the sectors and allocate it elsewhere like we did when we increased our weightings in both Valero and Delta Airlines. Apart from our most recent allocation changes, we are already looking into internally shifting the weightings of the previously highlighted sectors for my attribution report to lower risk while we push out some of these weighting changes that are viewed as more risk advised. We believe that in the past, we haven't placed sufficient weighting into our beliefs that have resulted in overperformance from the S&P 500. And that's something that we definitely are starting on and are going to continue doing. Now for the last slide, I have my allocation changes from 2 different time periods. This is the data that we presented at the ISM, the second ISM of this year, and this current data for this ISM. From an asset allocation strategy, we overweighted our energy sector to capitalize on demand that should arise from some of the topics that Jenny talked about, like our falling COVID cases and less uncertainty into the market. We took the weight from this change mostly out of the tech sector, which is why we are now underweight in it compared to where we were before. As of now, we are very much looking into changing our communication services and information technology sector, which is why our next 2 presenters are pitching stocks in both of these sectors. If there's no further questions, I'm going to turn it over to Justin with his information technology company. But if there's questions, ask away.
So your boldest bet here is on energy. Is that correct?
Yes, very bold bet on energy. That is what we have agreed upon. And that is why we have shifted our weightings like I talked about earlier and entered into Chevron with a high weighting in the energy sector there as well.
And those are similar feelings for why you're in consumer discretionary and in industrials to the point you are as well?
Yes.
Okay.
And that just wasn't talked about as much because we more so performed already in those sectors.
Okay.
Hey, Logan,
Yes.
what is the what is your bearish take on, like, what do you see as being the worst possible outcome for these bets? I know you're bullish on it, you think it's going to work out. Have you evaluated like what, from a risk management standpoint, what the risk is and what that might look like in terms of potential performance? Has that been factored in? If so, could you elaborate on that?
Yes, as I talked about a little bit earlier, we are moving around we are fixing some of the allocation differences that you see here with our upcoming trade requests that we haven't talked about, but I see us changing those allocations in a way that fits a less risk diverse portfolio that will really let us take these large stances in energy and consumer discretionary without posing too much risk into the overall portfolio. The worst case scenario would be something like the MU variant dealing as much damage as Delta has, but from the research I have looked into as of now, that is most likely not going to be the case, but it is always a possibility. So that would be something very hard to put into this portfolio just from speculation point. And it's not something that we want to do right now.
Okay, thank you.
All right.
Hey, Logan, I have a quick question real quick.
Yeah.
Because energy is such a like it looks like such a big bet here. What's the one thing that can happen from a macro level or top down level to make y'all realize y'all like if y'all were wrong, what could happen on the macro side to make you think maybe think twice about it?
It would be a drastic increase in COVID cases, or maybe what Jenny talked about with how we view our inflation continuing into the future, inversing from what we believe right now. Anything else would not change much on it, but I think those two are the biggest risks that we see right now. But we as Smile Fund do not see that happening.
Yeah. To answer your question probably more boldly, if the economy got shut down again, I mean, the energy sector would tank like it did last time during COVID, but hopefully that won't happen again. So that would be the worst case scenario, in my opinion.
That's a good one.
Thanks.
Anyone else? All right, let's turn it over to Justin.
Good afternoon. My name is Justin Martin. I'm a chief analyst in IT, and today my presentation is over Corsair Gaming. I currently have this stock rated as a buy with a price target of $37.12. This currently represents a 26% upside from the current stock price of $29.45. Corsair currently has a market cap of $2.76 billion. Next slide. My investment thesis for this stock is that I believe that Corsair can use its strong brand to capture market share in a higher margin peripheral segment. Their products are highly targeted towards enthusiast gamers, designed with quality, performance, and convenience in mind. Additionally, I expect there to be a spring in demand due to the easing of the chip shortage in 2022 and an upcoming refresh cycle. Next slide. Corsair is a company that designs, markets, and distributes gaming, streaming, peripherals, and PC components. The company was established in 1994 and is headquartered in Fremont, California. The revenue is split into two segments. The first is the gamer and creator peripherals, and the second is the gaming components and systems. Some of the acquisitions Corsair has made is that of Cfa Gaming, which is a custom and pro controller company, Elgato, which is a streaming hardware business, Origin, which is a custom and pre-built computer business, and Gamer Sensei, which is a small game coaching service. Next slide. The first category I wanted to highlight is the creator peripherals. These products are designed for those that want to live stream their gameplay and are sold under the Elgato brand. Elgato sells premium streaming hardware to increase the production quality of a streamer's broadcast. They offer a holistic product offering of all the products that are necessary to professionally live stream. Corsair offers free Elgato software to incentivize customers to repeat buy. And the software helps integrate their existing products with their new purchases. Streaming is a category that Corsair wants to be a top player in, and they recently doubled down on this with the release of their first camera. Next slide. The next category, gaming peripherals, are for gamers that are looking to increase their gaming performance. They feature products that give gamers a competitive advantage with features like a mouse that can track precise movements, keyboards with more tactile keys, aesthetic accessories like mouse pads, programmable lighting and chairs, and then convenience features like having multiple wireless devices on a single receiver or the ability to manage all of your gaming devices in a single app. The typical upgrade cycle for these products is about 3 years. Next slide. The last category is what Corsair is most known for. They have a long-standing reputation for high-quality products in the PC components and systems, and these products also integrate their lighting settings in Corsair's IQ software. Next slide. I created this graph pulling data from Bloomberg to illustrate the performance of the two revenue segments. In the most recent Q2 earnings, gamer and creator peripherals were only 33% of revenue, but they were 42% of the gross profit. Gamer and creator peripheral revenue has increased 40.9% year over year, which has driven growth by Elgato products, SCUF controllers, and other peripherals. Gaming components and system revenue has grown 17.6% year over year, which has been driven by more consumers building $2,000 plus gaming PCs. Gross margins decreased 70 basis points in the component and systems and have remained flat in the gamer and creator peripherals over the last year, which have been affected by increasing freight costs. It's additionally worth noting that historically, sales are seasonal, with the sales being slower in the first quarter and second quarter, and then sales are usually higher in the third and fourth quarter. Next slide. This graphic shows the product categories that Corsair operates in. The blue square indicates a similar product offering from a competitor. In the components and systems segment, Corsair has a strong brand and market share. As you can see, they are #1 in this category in all but PC cases. In peripherals is where I believe that they have more room to grow, innovate, and capture market share. Next slide. Now on to risk factors. Corsair faces intense competition in all the product categories that they offer from well-established competitors. These other firms may engage in aggressive price competition or marketing with changes in consumer demand, or as an attempt to capture market share. Additionally, shortages, increased input costs, and delivery delays impact margins and sales, which this was shown in the most recent quarter, where Corsair missed out on potential sales due to some products being out of stock. But to counter this, supply shortages are expected to ease in 2022, and management has expressed the ability to raise product prices if these input cost pressures are permanent. Additionally, the gaming industry demands evolve rapidly, and consumers can choose whatever brand of gaming gear that they feel best suits their needs. The most important aspect of these products are their online product reviews, but Corsair has had many exciting product launches over the past year, and I expect that to continue going forward. And lastly, on a more short-term basis, a private equity firm, EagleTree Capital, owns a majority stake in the company and has sold off a significant stake, going from 76.32% ownership to 59% over the past year. Going forward, they may plan to fully exit their position. On a long-term time frame, this will have a lessened effect as the stock price performance goes on. As a company I believe in for the long term, I think this creates an opportunity to build a long-term position. Next slide. Corsair was previously carrying significant high-interest debt. Using funds from their IPO and cash flows generated by the business to pay down debt, they are now in a much better financial state. They have reduced their debt by $53 million in 2021 and plan on paying down another $47 million for $100 million in total debt reduction in 2021. They recently announced refinancing, so their debt is now being carried at a lower interest rate. And additionally, their rolling credit facility has been increased from $50 million to $100 million. This move is expected to save $2 million a quarter in interest expense. And next slide. Some of the tailwinds that I see for the PC gaming industry that I think Corsair will be well positioned to capitalize on. The first is that in 2020, there are many new people who experienced premium gear, built their first computer, or live streamed for the first time. And I believe that our data shows that once someone has experienced premium products, they are not expected to go back to low-cost products in the future. This creates a higher base of customers moving forward. Additionally, the chip shortage has heavily affected the DIY PC market, which is for the type of person who is willing to build their own $2,000 plus gaming computer. Graphics cards, which are essential to building a performance computer, have been in low supply for nearly all of 2021, keeping many game enthusiasts from upgrading their aging hardware. As shortages ease, there'll be a new wave of people looking to upgrade their gear. And then lastly, as technology pushes forward, gamers will want to upgrade their computers to run the latest and most demanding games. And this creates demand for new computer components and gaming peripherals. Next slide. For my valuation, I arrived at a price target of $37.12. 2021 estimates were taken from guidance or issued by management in Q1 and have been repeated in Q2. After that, I created different growth scenarios, weighted their probability, and arrived at my blended price target. Going forward, I expect stronger margins due to the product mix being made of more profitable products. But however, I placed a greater weighting in my bear case due to the uncertainty of the private equity firm EagleTree Capital potentially exiting their stake. Next slide. In summary, I think Corsair is a buy for the following reasons. A shift to higher margin product mixes increases the growth rate of Corsair's bottom line. Also, high quality products and a strong brand will allow Corsair to capture market share amongst intense competition from its rivals and take advantage of a growing gaming market. And lastly, refresh cycles easing shortages, and a growing base of PC gamers will allow opportunities for future growth in the PC gaming market. Thank you for your time. I can now open up to any questions.
Justin, I thought your report was excellent.
Thank you.
I think, can we go back 4 or 5 slides? There was a chart with the margins, contribution analysis. Keep going, please. Yeah, that's it. Can you speak to the margins? I mean, those are pretty low gross margins. I mean, you know, I recognize they're primarily a hardware. I guess they're all entirely a hardware company, but those are nevertheless pretty low gross margins. What are their net margins?
Net margin, I'm trying to remember. I think it's 10%.
Well, so if I'm reading this right, you're talking about gaming components are running about 15% gross margins and peripherals are running at about 11% gross margins. So if you're talking about the debt that they're carrying, then their net margins probably are below 10%. That's not a very profitable, you know, profile, I guess is my point. Now, that could well be the case of the fact that you said they were heavily indebted because of a private equity transaction and some other factors. So that over time that might accrue to equity holders. And we'll see if they pare down some of their interest expense, some of their margin profile will improve. But I guess a couple things fundamentally I would ask you is, so there's a demographic play at work here. Okay, so I respect the fact that people your age, particularly males your age, are, you know, this is a big thing and it's a time consuming thing. It's addictive and the whole interactive aspect of it. But was it also not the case that because of the isolation factor with COVID, that there was a good pull forward of this? Wasn't there a big increase like year on year? One of the beneficiaries of COVID and the isolation were the personal computer companies and gaming in particular because of the isolation. So is there a possibility we could see a payback as more people get out and about and leave their, you know, house?
I would think the biggest pull forward has been in mostly the low cost products and obviously like the office products. But as far as like the more premium products, I think those will continue to see growth. But I don't think obviously it'll be near to the extent they had in 2020.
Okay, because I'm looking at some blips here. Looks like Q4, there was a spike up in revenues, Q1 of 2021, and it's similar. Now you're trending back down. There could be some seasonality to that, but it does to me, this chart does suggest to me there was a bit of a pull forward last year. Do you see that in your own chart? I mean, I just think it's worth addressing, particularly from the standpoint of your valuation. You look like you made some pretty conservative assumptions in your DCF. So I think you probably have protected yourself there. I wouldn't mind having the opportunity to review some of the other assumptions that are in there. Okay. But I mean, I would like to point out to you though, that these charts perhaps are already beginning to exhibit a bit of a payback from a pull forward is all I'm suggesting.
And this year too, they faced the headwinds of the demographic that would buy Corsair products typically also wants to build their own computer. And a lot of the chip shortages affect the graphics card supply. And it's gone a lot to like the OEMs like Dell and HP. And so like the more DIY market hasn't had a lot of supply. And so that's kept a lot of people from otherwise like upgrading their hardware.
So they're heavily relying on the NVIDIA chip too.
Mm-hmm.
Yeah.
They're a benefactor of you know, NVIDIA and AMD releasing like a more powerful products and stuff.
Okay.
Any other questions? And by the way, Ray, I would agree. He's put a couple of conservative assumptions into this, including that weighting of his bear case due to the secondary offerings.
Yeah.
And so I think that if you look at what their stock has done, some of that is due to the private equity being dumped onto the market. So I think that I don't, you know, I understand some of your concerns and that we're putting here, and obviously
Let me clarify. I'm not necessarily concerned. I actually like his idea, and I
Right.
like the work that's gone into it. I just throwing out some additional things to perhaps think about.
Sure.
The other thing I might throw out there too, from a portfolio standpoint, is now you have basically two holdings that are tied to some form of gaming, gambling, whatever. I mean, I know that DraftKings is a very different business, but you do have two entities that are involved now. You're
Take-Two.
Yeah, on Take-Two, right? Forgot about so you got three holdings now that are highly levered to this space, kind of in a broad sense. So that's reducing your diversification a bit. Strikes me also too that there's an aspect of that would benefit again if their views on COVID are wrong, meaning if Delta hasn't peaked or if there's another wave and there's some continued shutdowns, these companies should benefit, but they're not as likely to. I don't know. I'm just throwing out possibilities. It might not be as robust in the event that the economy fully reopens. So just some thought there.
Luke, are we using this Corsair possibly to trade out of a stock that we felt didn't perform well from a stock selection point?
Right.
That's the goal there, not to add it as another holding, correct? But to replace
Right.
it. Okay.
Right now, we would really like to evaluate our holdings just because our selection effect has been so poor this year. This business also, Justin talked on this a little bit, but as far as the chip shortage goes, yes, that's been a detractor in the near term. But Justin was also explaining to me that he also sees that as kind of a spring loading effect in the future to create more demand when those chips are available and they are able to buy those products. But yes, from a portfolio standpoint, this would be more of a replacement than in addition to the sector.
Okay. Very good job.
Great job, Justin. All right, for our last speaker, we have Dennis. He's going to talk about Nexstar.
All right, good afternoon, everybody. My name is Dennis Varghese. I'm a lead analyst in the communication services sector, and the stock I'm presenting today is Nexstar Media Group. I'm presenting them as a buy. The current price as of Monday was $145.92. I just checked this morning and they're trading around $151. And I have a price target of $172.71, which is a 18.4% upside. And so a quick company summary. Nexstar was founded in 1996, and they own, operate, provide sales or other services to over 190 television stations across the US. They also provide digital multicast signals to 116 markets, or in other words, they reach more than 68% of all US television households. Nexstar claims to be a source of less biased news. They leverage localism to bring services and value to consumers and advertisers through their television, digital, and mobile media platforms. Their portfolio includes all primary major networks, including ABC, CBS, Fox, the CW, and NBC. Next slide, please. All right. So my investment thesis is that although many consumers are making the move from cable to cordless media, Nexstar has become an outlier in the broadcast television industry among their competitors like Sinclair, Gray Television, and Tegna. As seen in the slide, the broadcast company recently delivered its strongest quarter on record in Q4 of 2020, reporting $1.3 billion in revenues, and more recently 1.17 for quarter 2 of 2021. With the majority market share of 68%, the best-in-class operator and their ventures into digital diversification, I believe Nexstar has properly positioned themselves to be a safe security to invest in the long term. So their business model is split into two segments, broadcast and other. The other segment is made up of real estate assets from their mergers and acquisitions and the elimination of their unprofitable stations. This is clearly not the primary source of revenue for Nexstar, as Q2 net revenues were just shy of 100 million. In Q2 of 2021, however, the broadcast segment brought in a net revenue of 1.13 billion, which was a 23.7% increase from Q2 of 2020. This segment is mainly comprised of their TV stations and the two main modes of revenue from those TV stations. Retransmission fees accounted for 55% of total revenue, and core advertising accounted for 38% of total revenue. And this chart is those splits, but compared with their next leading competitor in this industry, Sinclair Broadcast. So what is a retransmission fee? Companies like Nexstar Media and Sinclair get a large portion of the revenue from this fee. This fee is charged to Fox, NBC, ABC, and larger affiliates to air their programs at these local stations. These affiliates negotiate these legacy deals typically every 4 to 5 years. Next slide. In 1972, the FCC declared that a company can have up to 2 television stations in the same DMA or designated market area. This allowed Nexstar to create duopolies, or 2 stations in the same market, and essentially control that market. In January of 2021, they renewed agreements with NBC to continue operations in 33 of those markets that reached more and more Americans each week. Their next leader rival in this industry, Sinclair Broadcast, has 294 TV stations across the country, which is about 100 more than Nexstar has. And although Sinclair has nearly 100 more TV stations, Nexstar's pursue the most profitable and qualitative markets and has the top 6 local news stations in the US, such as New York, Los Angeles, Chicago, Dallas, and these are cities due to the duopoly market where Sinclair has no presence. By capitalizing on these markets, Nexstar makes up for a smaller number of stations with more qualitative stations. Political ad spending is part of their core advertising revenue. We are currently not in an election year. As you can see in the chart, every off year is a steep decline in political ad spending. The election cycle typically follows 2 and 4 year terms, as next year will be the next election cycle. 2020 was the highest year on record for political ad spending, and experts expect this trend to continue as well next year and into 2024 for the federal election. I view this political ad cycle as a guaranteed source of income for a broadcast company like Nexstar. So to kind of get away from their current business model of being just a cable company and retransmitting programs, they've been aggressive in their acquisitions. In 2019, Tribune Media merged with Nexstar in a merger that doubled Nexstar's TV station presence across the US. This merger also included all of Tribune Media's debt and a 31.3% stake in TV Food Network. I believe that this Food Network stake is their way to reach a younger viewership, as 29% of Food Network's viewership are in the 18 to 34 age group, as well as 65% of all viewers are under the age of 55. More recently, they acquired The Hill, and The Hill is a nationally recognized brand known for delivering balanced political reporting, and it's highly complementary to Nexstar's national cable news network, NewsNation. In 2020, The Hill had average monthly users of 48 million and 2.2 billion total page views, according to ComScore. On top of these acquisitions, they're also diversing themselves into multicast networks and mobile apps. In 2020, Nexstar's websites and apps reached more than 36% of the US internet audience. And in 2020, their internet traffic increased 133% from 2019. Nexstar claims that this is largely due to the COVID-19 pandemic, as well as the political cycle for 2020. Next slide, please. In their financial analysis, prior to recent elections, before 2016, Nexstar maintained a steady balance between revenues and net income. However, in the past 10 quarters, they've been aggressive in acquiring TV stations and other ventures, as well as taking on debt. And this is seen with the Tribune Media merger in 2019, as their net income was lower in 2019 than the previous 2 years, but is on the uptick for 2020. Future ROE for the next 3 years is projected to be 25.2%, compared to the industry average of 13.2%. The biggest risk, of course, to what I see to a cable TV's business model is the current trend to moving to cordless entertainment. For example, Sling TV is one of the biggest streaming platforms on Roku, and even in some of those basic packages, they have some local TV channels provided. As customers look to consume media in a more digital way, local advertising, radio, and TV are becoming more available on the internet as opposed to a physical cable. Newspapers have already seen a stark decline in the past decade, and so time will tell if Nexstar's diversifications will keep up with this trend. Another big risk that stems from retransmission fees are another risk that stems for their business model are the retransmission fees that they charge. Many of these deals are legacy deals that only happen every 4 to 5 years, but they have faced opposition in the past from their larger affiliates like CBS and Fox for the increasing price of retransmission fees. So that is something to take in consideration as we move forward. I did a comparative analysis with Nexstar and the top 3 leading companies in the broadcast industry. And you can see their market cap is the highest at 6.17 billion. They're leading in profit margin. And they also have the highest ROE, with the next closest company being almost 10% away. For my valuation, I did a discounted cash flow with a beta of 1.85, a terminal growth rate of 2.5%, and an interim growth period of 8%. This brought me to a target price of $183.68, which is a 26% increase from the base price of $145.92. This was quite the jump, but it is in line with other Bloomberg analyst valuations. However, I wanted to be more conservative and blend this with an EV to EBITDA valuation because I do believe that the market is trading closer to that valuation. With the blend of these two valuations, I give 50% weight to each one and came out with a blend of $172.71, which is an 18% uptick. I do believe that this stock is currently trading at a discount due to the consumer assumption that cable broadcasting companies aren't the future of technology. And to wrap up, Nexstar has proven that they are taking the steps to avoid that assumption of not being the future of broadcast technology. They are positioning themselves to be more than a company that provides local channels, and this is clear with their recent acquisition of The Hill, as well as their ventures into mobile apps into multicast technology. They also have the largest market share in their industry, reaching nearly 68% of all TV homes with their broadcast and digital services. Net revenues for their past quarters were all-time highs, and they also have the largest market share, which I just mentioned, sorry. But this is why I recommend Nexstar as a buy. I'm open for any questions, and thank you for your time.
I'll jump in. Dennis, nice job too on this one. Hunter, I think both of these company presentations were quite good. Couple of thoughts, and then maybe in the context also, again, of portfolios, somewhat directed toward you, Luke, in the sense that, so first of all, if we go to the slide that shows the political ad spend, my understanding of this is that this is stuff like that. So, my firm at one time we held Viacom years ago, and we had some CBS. We've had some exposure to the media space. We've owned some newspapers and so forth, and we've largely been out of that space for a while. So things could have changed a bit. But my recollection was that political ad spends are not necessarily good news because, yes, you've got a guaranteed advertising revenue coming in the door, but I think that they are offered those slots at lower rates. So what happens is if you're running a 30-second spot on prime time and you allocate that toward a political ad, that's a 30-second spot that you could not sell to another advertiser who might have been paying a higher rate. So I'm going to suggest to you, Dennis, you dig into that a little bit, just because I don't know necessarily that is that's a big windfall for these companies. Second, you're talking about a company with a fair amount of debt and you're showing a pretty high ROE. I think that screams for a DuPont analysis, especially one that shows it over a number of years. And I think what you might see is that a big chunk of their high ROE could be their leverage. So they might be boosting their ROE. It's not necessarily driven by their cash flow, but primarily by the debt that they carry. So I would take a look at that. And I think that'd be an important part of the analysis you do for this company. Dennis, you familiar with what I'm suggesting in terms of what we call the DuPont or disaggregation of ROE analysis?
Yes, and I was recommended to do one as well. I just didn't get it on the slide, so I apologize for that.
Well, I'm just thinking before you finish up, you might want to take a look at it because I think what it might show you is that a big chunk of their ROE is really just driven by them taking on a lot of debt. And that's typical of most of these media companies. The other thought too is, you talk about them making investments to kind of protect themselves against continued cord cutting. So they've bought some properties. What evidence do you see of them investing in those properties to create a streaming availability? So in other words, like, I think you can get the Food Network on the Discovery streaming app, and I don't know if they get to share in some of the streaming revenues associated with that, but I would take a look at that, because if we are indeed heading toward, I think we are indeed heading toward a a future where cable companies get disintermediated and everything goes to some type of streaming, Luke, what you've effectively bought is a hedge on Roku, and Roku is a hedge on this company. Do you see? But I think the two stocks in the same portfolio could work against each other eventually. In other words, it's a nice hedge, but on a net basis, if you look at it from a portfolio standpoint, they might wash each other out. I'm just throwing that out there as a possibility.
That's a great point. I really hadn't thought of that point right there, Ray. Luke, you might want to think of this stock if you decide to go with it as a replacement for Roku. You might not want to necessarily be thinking about holding both of those at the same time.
Right. And I of the two, I mean, I think that the world's heading toward a streaming format, right? So I do think that the cable companies, and this is a company that owns local affiliates, and so they're making their money, bread and butter on. Typically, when you watch a local TV channel, the heaviest advertisers tend to be car dealerships, those types of businesses. You see those net ads run every night.
Right.
That I don't think that'll go away, but is that a growth business is what I would ask. And are they going to be able to charge premium prices? And are they going to be able to, continue to fill those slots, and will they get the viewers, right? So
Ray, how do you analyze a company like this to see if it's being discounted too much for being going against the cable cord cutting trend when it might have some built-in recurring revenue and be a good investment that is also sees those trends and is making moves to kind of move in that direction, as well. So how do you value a discount like that when you know that every investor looks at this company is going to say, oh, well, we're not going to touch that because it's going against the cord cutting trend?
Yeah, right. So I think clearly you'd not view this as a growth stock. You'd look at it for how much cash flow it generates, and then what its command is of local markets. So you almost have to go market by market and look if they're in certain markets and they have a commanding presence in terms of market share. They're probably a good, stable business. But, arguably some of these media companies should probably not be public entities, which is why many of them go in and out of the private channels through LBOs and whatnot. They tack on a whole bunch of debt, avoid paying taxes and some other things. So again, question becomes from a portfolio standpoint, is this what the small fund wants to own? Now, Dennis, this is not a criticism of your analysis. I think your analysis is actually pretty good. I actually like the idea because I think instinctively you're kind of drawn to a high cash flow entity. It's kind of a value stock, right?
Correct.
So question being, look, I don't see necessarily a problem owning both this and Roku. I'm just saying as a possibility down the road, they could work against each other, right? And so that's the thing. So you've hedged one with the other, but a hedge is going to be inversely correlated if it works properly, right? So, one's going to be the inverse, meaning one's going to go down if the other goes up, theoretically anyway.
Yeah, I liked them for some of the value aspects, but, Dennis has also showed here, and we might want to research a little bit further, Ray, but he's showed that they're predicting a good amount of growth as well, which to me is interesting. If you can have your cake and eat it too. So
yeah, but is the growth all coming from acquisition, right? So the question I'd have is the growth all acquisition dependent? And then again, how are they financing that growth, right? So is it all through layering on more debt because interest rates are so low? So then suddenly you've got a company whose balance sheet looks real ugly, throws off a ton of cash flow conceivably, right? But is that what you want to own in the small fund? I mean, I'm just throwing out. I'm kind of like. These are like, to me, I'm just throwing out provocative questions that I think that the team needs to debate.
Correct.
In terms of what you want the fund to own. And again, I don't have any problems with this idea. In fact, I like it from an instinctive standpoint. I think you need to do a little bit more digging in terms of how they're funding the acquisitions, what their DuPont looks like historically, how much of their growth and their cash flow and profitability depends on leverage. I would do that fundamental work. Because conceivably then if they go too far too fast with this, you're looking at a potentially distressed entity. But beyond that, I'm just throwing out to the group, what does the small fund want to own? Do you all want to own primarily growth entities? or do you want to own something like this, which falls into completely different category of investment?
And we did look at a DuPont. He didn't put it on here, but it has one of the higher ROEs in its peer group and also a high profit margin, but it's got a lot of debt too.
Yeah.
Great job, Dennis. Any other questions for Dennis?
I just have a quick question, not so much for Dennis as for Luke perhaps and the team. So your first analyst used a terminal growth rate of 2%, and the second analyst used a 2.5% terminal growth rate. How do you all think about this?
To be straightforward with you, we left that up to the analysts. I think that's something in the future we need to keep together. That's a great point, and I think the next ISM and everyone after that, we should use the same terminal growth rate.
I struggle with this idea myself, and it seems like the terminal growth rate, I'm not sure, is dependent on the stock being analyzed, right? I mean, it's a function of some macro view of things. And I don't know.
Well, Bento, I would point out that I think he adjusted it from the 2% number because there was a little bit more of a multinational presence with that company. And so that jumped the GDP, average GDP of the countries they're in up a little bit. But they can speak to that. But I believe we did have that conversation that if it was purely domestic, it was going to be 2%.
Okay.
I mean, so Luke just wanted to point out it should not be the same for every company. I mean, you made a statement saying that you'll make it the same for every company. It should not be the same for every company. For example, I mean, I remember like a couple of semesters ago, we did KTOS. And for that, the terminal growth rate was assumed to be like a 6 or a 7%. And at that time, we had like a discussion of how this could be 6 or 7%. But the idea there was that this is a very rapidly growing space. There can be much more expenditures. It grows faster than the GDP and stuff like that. So there are macro factors which affect the terminal growth rate, but it is also dependent on the space that they are in. Now, to Dr. Lobo's point, I personally think that for Corsair, your terminal growth rate could be greater than for your other company, because that's more into the gaming space and the rapidly growing space. And as Ray pointed out, and there are some comments as well, I mean, the broadcasting space is probably not going to grow at such a rapid pace. So, I mean, kind of you got it.
Nilesh, I'm kind of I kind of disagree. I don't know. To me, the terminal growth rate is the forever growth rate, right? And
right.
What you're suggesting here is that some growth firms may have differential growth rates leading up to a terminal growth rate.
But they're only forecasting for the next 2 or 3 years. I mean, you can. I mean, that way you would have to probably forecast for a longer period of time.
But that terminal value is a huge part of a DCF valuation.
That is close to 70 to 80%. I agree.
That's right.
Yeah, I agree with that. But I do think that they can be different for different companies. They don't have to be the same.
Well, I would say that we're running close on time, so I'm gonna I'll bring this back up. But traditionally, just to update everybody, we have told the analysts to factor in any specific sector growth or stock related growth into the interim period. And we have used the terminal value period to determine basically the GDP of the country they're in. And for some stocks, it has been a lot higher, but that is usually because that company has a bigger presence in other countries that have higher GDPs than the United States. Is there any other advice before we go? Any other feedback that anybody wants to provide?
I think what you just said actually is a decent approach, Hunter. I hear Nilesh, I agree with him. I hear Bendo, I agree with him. There's a couple ways, but I think, maybe we should discuss further. I think that's a good topic for exploration as y'all build these DCFs out. But yeah. I can't join you all for lunch, but I'll stop over and say hello when you come down.
All right, that sounds great. Well, thank you, everybody. This concludes the first ISM of this fall semester. The next one will be on campus. That's our 100% goal. We love to see everybody on campus, and we look forward to making that a great ISM as well. Great job to all of our presenters, and thank you all for coming. We look forward to seeing you next time. Goodbye.
Thank you.